Hi, and welcome to Random Rogers Big Picture for the week of August 24th. Two things on the agenda this week. One, a quick look at the S&P 500 and where it stands. And then, if I have time, a little bit about a touch of ETF news. Okay, so first up, the S&P 500. As I've written probably out of 3,000 posts, probably a couple thousand of them, a little bit of hyperbole, talk about how I use the 200-day moving average as a trigger point for defensive action or to re-equitize. And so it makes sense to maybe talk a little bit about where we are in relation to the 200-day, just so you know that I'm actually keeping tabs on it. As I look at the chart, the 200-day moving average for the S&P 500 is at about 1350. It's a hair over, but it's for where we are right now at the actual index level, that's close enough for the discussion. So, closed Friday on the S&P at 1292, and so that's about 4.4% away from where we are right now, up to 1350, where I would begin to re-equitize if it happens. And just as a quick technical note, assuming it plays out over a period of weeks, if the market keeps going up, the 200-day probably would keep coming down a little bit, as some of at the back end, the numbers start to get lower. But it's meaning that they might converge at a number lower than 1350. But for where we are right now, 1350 versus 1292, 4.4%, that doesn't sound like a lot, does it? So, if it doesn't sound like a lot, chances are it isn't a lot, which is the whole point. In that, laid out ahead of time, I talk about when the bottom comes, we're not going to lead off the bottom in using this sort of get defensive approach, but we're not going to miss it. We're just going to lag it. And then we'll start to re-equitize as we get back in. And I kind of use this phrase a lot about it's okay to lag a big move off the bottom, but it's not okay to miss it, which is why I don't go zero weight, which leaves me having to guess, was that really the bottom? There's a lot of energy and attention paid on things that you read, also the things that you see on TV about whether now's the bottom and what you should do, implying that there's some sort of urgency, which, if you've been reading the site for a while, I think is probably the worst way to invest. It's very reactionary. It lacks a plan, in my opinion, and it lacks discipline. If we go up 4.4% up to that 1350, and let's say the bottom is in, we take out the 200-day moving average, and it's off to the races. Low probability, in my opinion, but absolutely possible. If that's what happens, and for the sake of discussion, I only capture half of that 4.4%, and then I re-equitize, and then at 1350 we're off to a normal bull market. Well, let's see. If I remember my Hussman correctly, a normal bull market we might expect to see over a period of several years 180% lift in the market, followed by a 50% retracement of that 180% lift, followed by a 50% retracement of that, but let's not worry about that now. But so if it holds true to that sort of historical form, and at the moment probabilities of that don't matter. But if that's the case, then lagging by 2.2% or 3.2 or 1.2 means nothing. Totally irrelevant in the context of should a new bull market start, and should that new bull market be something close to normal. So people get very worked up for really the wrong reason, and that's an important thing to grasp. When demand, the macro, the thing behind the thing of what I'm trying to do is when demand is unhealthy, miss a big chunk. I didn't miss all of it, obviously. That wasn't the goal. That's not realistic. But miss a big chunk. Then when demand gets healthy, re-equitize in some sort of logical manner and hope that you catch the majority of the move up. And I would imagine there'll be times where you're ahead of a move up and times where you're behind. But if you're generally catching the move up, and if defensive action results in missing a big chunk, over the course of the entire stock market cycle, you have a very good shot of outperforming. At least I think you do. And that is kind of the big macro. And worrying about this short-term stuff, is just wrong on many levels. One, it will, whatever your state of emotion is, it will enhance that in a negative way. Two, the odds of being, really right on a regular basis about that sort of thing are pretty slim. If you try, you will nail a couple of those things over an investing career. Maybe as a function of just dumb luck, I don't know. But that is a reasonable expectation. But repeating over and over, nailing bottoms and nailing tops, that is just a tall order. I'm not trying to do it because it puts clients in too great a risk of, I'm not wording that very well, but too great a risk of having what I think would be undue volatility. Just trying to smooth that right out as best as I can. That's a pretty important thing. I think, back to the thing about how do you choose an advisor, we always tell people, well, yeah, you want to smooth out the ride, don't you? And they say, yeah, we like that. It makes sense to me, and that is the God's honest truth. But there are some people that probably don't actually care about that. Okay, on to ETF news. One is the Health Shares Index Universe has this. That is a site that you probably should be visiting on a regular basis for ETF news. Says here, they're closing 15 of their funds, the Health Shares funds. These are things like, let me scroll down here. Not here, but things like pulmonary, I think infectious diseases, emerging cancer. The cancer drug made the cut, but the emerging cancer, whatever that means, did not. Ophthalmology. I believe there was one that pertained to diabetes. That one, forget about it. My thought on these from almost the start was that if you have a bunch of real small or maybe even micro-cap companies all in the same narrow field, like endocrinology, if that was even one of the funds, and I'm sorry, I don't know. But, they're all going after the same, plot of land. So this means there's going to be winners and there's going to be losers. And I kind of wrote a couple of times that I can envision, the winners offsetting the losers and the funds not doing much. I haven't looked. I don't know if that was the case. But for me, out in front, that was a reason, just to disregard them. I think, by the way, that effect is the case with just regular biotech ETFs, like the IBB or that, is it BBH or BHH, whatever the biotech holder is, not really an ETF. There's an awful lot of offset that goes in, and I don't think IBX might be another one, and not great as far as, or maybe XBI. I think you're better off going into individual stocks than the funds, because there isn't an awful lot of offset that goes on within. Also, a couple of, I guess these are just listings yet, but Delta Global, who I have an affiliation with through Green Faucet, has filed for, or is at some step in the process for a global shipping ETF. In a way, this makes a lot of sense to me, and in a way, it doesn't. Where it makes a lot of sense is, if you saw that Dry Ships today, I think the ticker is DRYS, I'm sorry, on Friday. If you look at that, Dry Ships had an earnings miss, the thing got clocked. I don't know how an investor buys that stock ever. That thing hops around. I looked at it one time a while ago, it was in the 60s. 10 minutes later, intentional hyperbole, it was up around 100. With this earnings miss, it was back down around 67. One that I've been following for a while, and I possibly might add, is, along with a couple of others that I'm picking from, Nordic American Tanker has a whole lot less juice than this DRYS. Where this fund may not make sense is if it captures, the move. There are others like Dry Ship that are just, nuclear hot potatoes. If the fund ends up like that, then it becomes a difficult investment vehicle as opposed to a trading vehicle. It could be a phenomenal trading vehicle for those folks that are interested in that. You know what? I think I'm running out of time, so I'm going to stop here. Have a great weekend.